So we have the key features of a bond. This is just like how we describe a bond. And in this class, we'll always use $1,000 for the par value of the bond. That means when they initially need to borrow money, I would loan them $1,000 for however many years, and they pay me $1,000 back in the future. Then along the way, I should earn interest because I loaned them my money as the investor. And so I will get a coupon interest rate. And like I mentioned a little bit earlier, the coupon interest rate is stated as a percentage of par value. So if it's a 6% coupon bond, that means it pays 6% times 1,000 or $60 a year. The coupon rate, it could be paid monthly, semi-annually, quarterly, yearly. There are all types of ways it could be set up. Then we have the maturity date, and that is just the number of years until the bond is due for the company. Just like if you have a mortgage that's a 30-year mortgage, everything should be done and paid for in 30 years. For a bond, it's a little bit different in that they're not making principal and interest payments like for a mortgage, but they end up paying interest over 30 years and then they pay the huge amount of principal back at year 30. And that's just for a 30-year example. The issue date is when the bond was issued. So that just means it could be May 22nd, 2015, which is today for me. And then the yield to maturity is the rate of return or the promised yield that is what you should earn if you hold the bond until maturity. Yield to maturity can change over time, whereas the coupon rate stays the same if it's a fixed coupon rate bond. So the yield to maturity is like the current rate in the market. If I need to 30 days from now issue a bond and I'm a company, what interest rate would I face? That's the yield to maturity. And that's what's used to price a bond. In your financial calculator, the coupon interest rate is a percentage and the yield to maturity is a percentage, so you don't want to get them confused. The coupon interest rate is just used to calculate the payment that goes in the payment key for the calculator. And the yield to maturity is the I/Y. So it's the discount rate used to find the present value of the bond, which is the same thing as finding the price of the bond. Another type of feature for a bond is that the bond can be issued as a callable bond, or it's called a call provision. So a callable bond allows a company to buy back or pay back its bond early during a certain amount of time for a certain price. The reason why a company would issue this type of bond is because interest rates could decline over the life of their loan. And if interest rates go down, the company should try to reduce its interest expense by refinancing their loan at a lower rate. And so what they do is they call the bond back. All the investors have to give up the bond. They pay a call premium to those investors because they took it back early from them. And then the company will reissue their debt at a lower interest rate in the market because they only do this when interest rates go down. If interest rates had gone up, the company keeps their bonds because they're in a better position than going out and issuing new bonds at a higher interest rate. Now, interest rates have fallen, that's why the company called their bond back, and the investors have to find more bonds and face a lower interest rate than what they were receiving. However, the investors knew when they invested in the bond that this was totally possible. So, since a callable bond is riskier for the investor, companies must pay a higher interest rate or coupon rate on a callable bond. So if you looked at two bonds that were basically the same and one was callable and one was not callable, the callable bond would have a higher interest rate than the non-callable bond. And that's to compensate the investors for the extra risk that they're taking on. Another feature is a sinking fund provision. And this just means the company pays down the principal over the life of the loan instead of waiting for 30 years and just paying $30 million back at year 30. This makes this type of bond safer for investors because they are getting their principal back over the 30 years. So if it was $30 million and they repaid $5 million down of their principal every 5 years, then that would be less risky than waiting till year 30 and trying to get paid back the full 30 million. And the reason why is because what if in year 29 the company went bankrupt? Well, you wouldn't get any of your principal back. You would have received the interest payments over the life of the loan, but you would have lost a huge amount of money. So, since this type of bond is safer for investors, usually a bond with a sinking fund has a lower coupon rate or interest rate than a similar other type of bond that doesn't have a sinking fund. How are sinking funds executed? For the company, they kind of get the best of both worlds. As they are repurchasing or buying back their principal, if the bonds are selling for a premium, and that means like if each bond was $1,000 par value, and if they're selling at a premium, that means they're selling for above $1,000. So for them to have to buy it back, they may have to pay $1,200. Well, they don't have to because they get to call, like the callable feature, call back a percentage of the issue at par. So they can get it back for $1,000 each for however much, in bonds that they issued. Now, if the bonds are selling at a discount, which means that their price is less than $1,000, the company gets to just buy it back in the market at a discounted price. The most they'll pay is $1,000 par value, and then the least they'll pay is however much the discount might be from $1,000. And this whole thing about being a premium bond or a discount bond has to do with when market interest rates change. When market interest rates go up, bond prices go down. So this is the second example, and bonds sell at a discount. When interest rates go down, market prices of bonds go up, and then a bond is selling at a premium. So here's just the general way we value anything. This is a timeline with cash flows, and they're all being discounted back at some rate R. And this is what we learned in Chapter 5, and this applies to when we're talking about valuing bonds and valuing stocks, valuing projects for companies, all of those types of things. And so you can just see that the value of whatever we're talking about is based on discounting each cash flow back by the required return. So we have even more types of features for bonds. If I invested in a convertible bond, then at some point it would become profitable for me to exchange my bond for common stock in that firm. So if I bought an ExxonMobil bond that was convertible, at some point it would become profitable for me to convert it into ExxonMobil stock. And so it's like having a call option within a bond because you get to, at a certain price where it makes sense for you, you convert the bond. And that's a very neat feature because you can then change your security entirely. If you wanted more dividend payments instead of interest payments, then you could convert it into the stock. A warrant is a long-term option to buy a specific number of shares of the common stock, and it's at a specified price. So this is like a call option that's built into a bond issuance. A warrant could be detached from the bond and sold in the secondary markets. we say it's a long-term option because usually the expiration date for this type of call option that you're getting is up to 2 years. That's a pretty long time for you to make some money on a company's stock. Hopefully in 2 years, the company's stock has risen dramatically and you can buy it at a cheaper price and sell it for a higher price and make quick money. And then we have a puttable bond, which is just the opposite of a callable bond. So a puttable bond allows the investor of the bond to sell the bond back to the company before the maturity date. This is usually issued by financially weak companies because this is a horrible type of bond for them to have to issue. So the investor, they could just decide at any moment, well, I don't like this bond anymore. Give me all my money back. The strong companies, like your blue chip companies, large cap, mid cap, those kind of companies are never going to have to issue a puttable bond because this is for companies that are not doing so well. An income bond is the type of bond where the company only has to pay interest when interest is earned by the firm. So it's kind of unique. And then an index bond is just where the interest rate is paid based upon the rate of inflation. So right now in my investment portfolio, I have some Treasury inflation-linked securities. So it's going to help me get close to the Treasury yield just for a safe part of my investment, but it's inflation linked so that if inflation goes up, my purchasing power is kept the same. If we're going to find the present value or the price of a bond, we need to know the opportunity cost of debt capital. And that's just the discount rate we're going to use. If you remember in chapter 6, we looked at that theoretical rate, and it's a real rate used in real life, but we looked at it a theoretical way where we said it was, R star plus inflation premium plus all of those different components. That's the rate that we should be using to price the bond. So here's an example, and after a while you'll know that if you ever see something like this again, you don't even have to really do a calculation. What is the value of a 10-year, 10% annual coupon bond if the opportunity cost of debt is 10%? Like we saw before, we would value the asset, which is a bond, by taking each payment. So if it's a 10% coupon rate, 10% times 1,000 is equal to $100. We're assuming it's annual because they said annual. So $100 the first year, discounted back one period. That gives you the present value of that one interest payment. And then you keep doing that over and over until you get to year 10. You get your last $100 coupon payment and you get your $1,000 back if you're the investor. And all of that has to be discounted back to the present. And we sum up all those present values and then we get the answer 1,000. The price should be 1,000. The reason why we get 1,000 here is because the coupon rate of 10% is equal to the opportunity cost of debt, 10%. Anytime those two rates are equal to each other, the answer, as far as this class goes, is always 1,000. Okay, so that's something you can always know. Now, if the coupon rate is different from the discount rate, or RD, then you will get some other answer than 1,000. And so you will have to enter this type of information into your financial calculator.